Hi, everyone. Welcome to Questrade's webinar series. Thank you for joining us. My name is John, and I'm your host from the Questrade education team. Joining me shortly are our two special guests, Jessica and Tony from OptionsPlay. Before we get started, let's quickly go through some important notes and a disclaimer. So today's session will be recorded, and we'll have the on-demand version available next week. If you have to duck out early or would like to rewatch an important section, we've got you covered. Please keep an eye on your email inbox for the recording. And if you have any questions during the presentation, please type them into the Q&A window available at the bottom of your Zoom interface. That's the Q&A and not the chat window. Our agents can help answer simpler questions throughout the presentation, and we'll be hosting a longer question and answer period near the end of our webinar today. And if you're having technical issues or have general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. Now, before we get started with today's presentation, I'm going to take a minute or two to show everyone how you can enable options trading in your own Questrade account. When you first set up an account with Questrade, you're asked if you're interested in trading options. If you choose yes during setup, your account is automatically enabled for level 1 options trading. Now, if you're interested in more intermediate and advanced options trading, this is how you can change the options level in your Questrade account. First, you'll need to log in, and after logging in, please head to the Account Management page found under the Account Management top navigation menu. This is going to be right here. On this page, we have a number of different settings, but the one we're looking for is about halfway down for options level. Now, please note, these settings are per account. So if you have more than one Questrade account, you may need to enable options trading in more than one account. Now, to change your option level, all you need to do is click the Change button with the little pencil next to it, and wait for the page to reload. Now, if you're upgrading your options level from 1 to 2, 3, or 4, you also may need to fill out a Questrade options agreement form. This can be downloaded right from this page and uploaded under the account management option. So you can download the form right here. And once you've filled it out, you can upload it to your account under account management and upload documents. After changing your options level and submitting the form, your account will be ready to go for options trading within 1 to 2 business days. Awesome. Thanks for bearing with me there. And if you have any questions about options levels, please check out the link in the chat that my colleagues have posted for more information. And here's a quick disclaimer. Now, please remember that the information conveyed in this webinar is for informational, educational purposes only and does not constitute advice or recommendations by Questrade. All right, now moving on. Without further ado, I'd like to introduce our two guest speakers today, Jessica Inskip and Tony Zhang. Jessica is the Director of Product and Education at OptionsPlay and has been a prominent figure in the online brokerage industry for the last 13 plus years. She specializes in options trading and derivatives, and her main passion is investor education. And as the Chief Strategist for OptionsPlay, Tony has assembled and manages an agile team of developers, designers, and quants to help create one of the newest innovations in options trading and analysis. You can also see Tony and Jessica as regular guests on CNBC's Option Action Show, where they discuss popular options trading techniques and help demystify this crucial corner of the market. We're very excited to have them here to present today. And with that, I'd like to pass it off for the main event. Thanks, everyone.
Thank you so much, Jonathan, and thank you so much for everyone here at Questrade on hosting us for this wonderful event. We have a lot in store with you here today with Jess and I to discuss quite a wide variety of option topics to help you get started with options and help you better understand everything from the contracts themselves to best practices around some of the more common strategies and some of the risks that you should be aware of when using these types of strategies. So today, what I'm going to do is I'm going to kick this off with Jessica helping us start the event, giving us a brief overview of options, and then I will come back in and we will discuss option strategies, some of the risks involved, and have an active discussion with you guys. Please feel free during the session to tell us your comments, what your thoughts are as we go along. We will answer questions here at the end, but if there's anything, we'll try to address as much as possible as we go along. And there's a full Questrade support staff team on the session. So please type your questions into the Q&A window as we go along. We are here to help answer questions during the session, even though at the end, Jess and I will host that Q&A session. So please, with that, Jessica, please, let's get this started.
All right. Well, thank you everyone for having us today. echo what everyone said, and we really do enjoy these sessions, and we're looking forward to some great participation. So please keep those questions coming. They're very important. Before we get started, it's important to share with you just an important disclaimer. There is a lot of examples in here. They're for informational and educational purposes only. They are not any tax advice or legal advice. They're purely just for educational purposes. So absolutely do your own research as well. This content is produced by a third-party OptionsPlay in tandem with TMX and Questrade. So know that we're not affiliated with either of those two, and that content is something that's been created by us, and those are separate. So those are the things that we need you to know before we dive in. So as far as what we're going to cover today, this is an extension of the Options 101 course that we hosted with you guys a month ago, I believe. So I'm going to do a quick review of that, though, just in case you didn't attend that. That was just a foundational aspect where we understood options, and this is building on the best practices involved when you're trading options. So we'll do a quick review of that. We'll go over types of options, and we'll focus on something specifically, and I'll show you the tools to really understand it, utilizing charts and things of that nature. We'll talk about how to choose optimal strategies. So how do you choose strike prices and expirations? What are the best practices around that? What does that mean? And also the why, because that certainly helps wrap your head around that. And as well as strategy management, because that's something that's extremely important with options trading. And we'll talk about assignment risks in particular, which is something very important with short options, which we'll explain along the way, go through those best practices again, and of course, save time for live Q&A at the end. But the real question that we're answering today, and that I want you to think of while we're going through this presentation, is what are the risks and actions I need to be aware of when trading options? So let's start with a quick review of what an option is. An option is essentially a contract. And with every contract, you have a buyer and a seller. And you can be on either end of that, whether you're purchasing an option or you're selling the option. The contract is issued at a price, and that price is known as the premium. And the way that price is derived is something that we covered on the previous one, and we'll talk about that very briefly. It can be issued with the right to buy something or the right to sell something. If it's issued as a call, that means it's the right to buy. The put is the right to sell. In the example here, I've got 100 shares of ABC per share. That means if this was a call and it contained the right to buy, I'd have the right as the option buyer. I'd pay a premium for the right to buy 100 shares of ABC at $100 per share at any time until the expiration date. In this example, it's May 20th. And then there's a premium associated with that contract. And then the seller is the one that receives the premium. As the buyer, I'm the one paying the premium. So just a quick review of what an option is. Now, this is a chart. Go ahead.
I just want to jump right in real quick here. If this slide and kind of the details of buyer versus seller and premium and kind of the almost feels like legal jargon, it sort of is. And the reality is that it is legal jargon. It's contract, right? But that's really kind of what we're hoping to do today, is take it away from kind of these terminologies and really talk about when you want to be a buyer of an option, when you want to be a seller of an option, and take a much more practical approach. So hopefully you'll be able to walk with that away with that today.
Yeah, great value add. All right, and then this is the T-chart that we put together at OptionsPlay, and it's really something from an education perspective, or wrapping your head around options, really important. So the way that and if you've never seen this before, let me give you just a quick brief overview of it. But the thought process is, if you understand long calls really, really well, you can really understand everything else, because it's essentially a mirror. So the way this T-chart works is we have calls on the left and puts on the right, much like an option chain. Long calls are on the top here. That's considered a bullish strategy. Short puts are on the top here because it is also considered a bullish strategy. And you'll notice if you're buying an option, that's where you have the right. So I have the right to buy in the case of a call, or the right to sell in the case of a put. If I'm short the option, that's where the obligation kicks in. So for a short call, it's just the inverse is true. If as a long call holder, I have the right to buy. If I'm selling that option to the long call holder, I'm obligated to sell the underlying at the strike price at the long call holder's discretion. And then the inverse is also true on the put side. So with that in mind, you can really focus and learn long calls really, really well. And if if some reason you're not following along or that happens, that's what we always tell you to go back to is long calls in this chart, and then that will help really put everything together. And this is a really great tool as well, just to understand time and where profits are coming from. So I do want to make sure we just cover it really briefly before we go into best practices. So mind you, this is just a short review of our last session. So anything that is a long option, time is not in your favor. We talked about an options premium, and an options premium is primarily comprised of two components, intrinsic value and extrinsic value. Intrinsic value really means the actual value of the contract. So if I have the right to buy ABC at 100 and ABC is trading at the market at 110, well, that option has to be worth at least $10 a share, because I can execute upon those terms of that contract, buy ABC at 100, utilizing the contract, and then immediately sell at the market at 110. So that's where that intrinsic value is coming from. Anything that's in excess of that is extrinsic value. And a major component of that is time value and implied volatility. So that time piece, the longer that the contract has until expiration, the more expensive it's going to be. And that's quite logical, because think about it, you have more time for it to go above or below your strike. Therefore, it's going to be more profitable. And then implied volatility is that third component of extrinsic value, which is simply think of earnings, for example. We know that the stock's going to make a really big move up or down in either direction. So implied volatility is going to be higher, which means the option is going to be more expensive. So those are the pricing components that you just need to be aware of. But this chart also takes that into account of how it affects the options. And that's why this is really just a good one to keep. Take a screenshot of it. A lot of people even have these posted in a lot of places. But what I want you to take away from this is anything that contains the right to buy or the obligation to buy is on an individual basis bullish. Anything that contains the obligation to sell or the right to sell is bearish. So pretty logical. Time is not your friend if you're buying an option, because it's decaying. And if we're buying an option, we want the underlying to move in our favor as much as possible, which means they both profit from sharp movements in their favor. And then the inverse is true for the short options. Time decay benefits because you're selling and you want to buy it at a lower price. So as time goes on, the option goes down in value. That's good for you. And then they don't profit at you. Any really fast movement or sharp movement is considered risk for short options. So that's the important takeaway there.
And for many viewers looking at this, you might actually be surprised to learn that as you advance your education, you actually don't trade any of these strategies in isolation very often at all. Many times what you're doing is, or the purpose of this chart is really to help you learn the foundations, because long call, long puts have certain benefits of asymmetrical risk, but they have a fairly significant trade-off on the back end of that. And short puts and short calls have the benefit of time decay, but they also have very negative risk to reward. So ultimately, when you're actually trading, or as you get more advanced and learn more, you actually use a combination of these strategies together to trade them. So at this point, the most important thing is just to really think about learning these as the fundamental building blocks and not necessarily them individually as strategies per se. So just keep that in mind as you go through your education, where you might think to yourself, I don't think long calls or puts make sense for me, or I don't think short calls and long calls, short puts and calls make sense for me. Just think down the line that you're more likely going to use a combination of these strategies together in order to actually achieve your objectives. But today we're here to just kind of learn those building blocks.
Now that leads into the first really component that you need to know in trading options is know what strategy aligns to your goal. So a lot of times we talk about where you feel the underlying security is going to be. And with options, you actually tend to fall into one or two buckets, and it could be a combination of either depending on your sentiment and how you feel about the security. And we'll talk about understanding optimal environments and how to choose that. But you'll fall into seeking income or gaining directionally. And that will make sense here based on the building blocks and what we outlined previously. So if you're seeking income, that means you are trading, for example, covered calls or cash covered puts or credit spreads, and we'll go into specifics. If you're gaining directionally, then you're wanting to profit from large movement upwards for a call, a large downwards movement for a put. And so that's a directional play or a directional strategy, whereas seeking income is different. You may be neutral, but you still have a bias to one direction or the other, at least with the strategy examples that we have on the screen. There are certainly ways to utilize options where you could be neutral as well, and we'll talk about that. But the important component to know is if you are trading options, you tend to fall on either one of these. You're looking to seek income or gain directionally, and there's a way to even combine that to do both. So your goals could be neutral. Your ideal outcome for seeking income, though, is for your option to decrease in value. If you're gaining directionally, you want it to increase in value as much as possible. So it's really on what side of that contract are you on? Are you the buyer or the seller? If you're seeking income, your strategy driver is going to be the selling side. And if you're gaining directionally, your strategy driver is going to be a long option.
Yeah, and just to be clear in terms of why, seeking income, you want the value of your option to decay, it's because that's when you're selling an option, right? So whenever you effectively short something, you want the value of that option that you've sold to get as close to zero as possible, because that's where you seek your maximum profit. And vice versa, when you're trading directionally, generally speaking, you're going to be long an option, or at least the driver of that strategy is going to be a long an option. And whenever you're long any asset, whether it's a stock or an option or a commodity, you want it to rise in value so that you can potentially sell it at a later time at a higher price than what you purchased for. So that's why these two are different. I know it might be a little confusing as to why income you want decrease in value, but it's really because you're selling an option, and anything you're selling short effectively, you want to decrease in value in order to profit.
So we're going to cover seeking income, and I see a lot of questions saying, what's a cash covered put? What's a covered call? Really glad to tell you that we're going to explain that now. So a covered call, what is that? So we're going to start with seeking income, and we'll cover the two most popular strategies that are single-legged strategies for seeking income. And the first is a covered call. So a covered call requires first for you to own 100 shares of an optional stock or ETF, because in option contract, one contract generally represents 100 shares. Therefore, you need to have at least 100 shares to write a covered call. You sell a call using that stock that you already own as collateral, and in exchange, you receive a premium. What that does is it creates an obligation to sell the stock at a specific price. So go back to that ABC 100 strike price, that's 30 days out. With a covered call, what you're doing is you're saying, okay, well, I already own ABC. Let me take the obligation that the call is inherent of, which is selling at 100. If you're the seller, you have the obligation. I'm willing to sell my shares of ABC that I already own at $100 a share. And in exchange for that, I'll receive a $5 premium. And that's a way to reduce your cost basis for the shares that you already own. You do give up upward potential for those shares if it goes above your strike price, and we'll talk about that. But it's a way to generate income off of the shares that you already own, and even in addition to the dividend that it already receives. And we'll talk about the risks associated with that. But what's interesting about that is, if you notice, we're talking about a short call. And on that diagram in the beginning, the short call was on the bearish side. But because now we're creating a short call utilizing our stock that we already own as collateral, we turned it into a bullish position, because your stock is going to be the main driver of that strategy. And we use that terminology a lot. But what that simply means is there's something that has a larger driving force in your strategy. In this case, it's the stock. You own stock, you want that to go up directionally. So you actually create a bullish strategy utilizing a short call by owning the shares. So this line right here represents your long stock. So you have your long stock, you can make theoretically an infinite amount of money because it can go to an infinite price. But the trade-off here is you are capping your gains at the strike price that you choose in exchange for a premium. But in addition to that, you reduce your break-even price. That's what this represents. So if you purchased ABC at $90 per share, you sold the call for $5. Well, your risk for ABC was the $90 per share initially, but because you received $5 per share, you reduced your risk to $85 per share. So there's a balance of receiving income and gaining directionally, and that's the benefits of a covered call. You still have substantial loss potential, but it's substantial loss potential that's equivalent to owning the shares. And the real risk trade-off here is the upwards potential. So if ABC was to go above your strike price, you are not going to participate in that additional capital appreciation because you created an obligation and a predefined sell price. Often like a limit order, if you've ever put in a sell limit order, you say, I'm okay selling my shares at this price. And if you walk away and the bid hits that price, normally that's going to execute and you may not have even known it. It's a very similar concept, not the same because this involves options and there's an expiration date, but it's a very similar concept in a way.
And I'll just comment here. I've heard from a lot of investors, the obligation piece, the obligation to sell your stock or ETF at a specific price. I've always heard from users of cover calls that they don't love giving away upside. No one likes giving away upside. But the one thing I do want to, as Jessica said, is the fact that there's another thing that you're currently doing that also gives you the same obligation of giving away upside, which is a limit order. When you place a limit order at a higher price than where the stock is trading, you are limiting your upside at the same time. Most people don't think of limit orders as an obligation to give up your upside, but that's effectively what your limit order is doing. But the difference between a limit order and a cover call, which is not a fair apples to apple comparison, I just want to be clear on that. It's not exactly the same thing, but the obligations between the two are exactly the same. But the difference between a cover call and a limit order is that a cover call pays income. And I'm going to go through a real example here in just a couple of slides to show you how much income and how do you go about selecting where you choose that obligation on selling a cover call.
So let's flip over to the cash covered put. So this, you'll notice, has a very similar profit and loss diagram. And I apologize that I didn't explain this too fully before, but anything in the green just means it's profiting from the stock moving up, and anything in the red, at least on this side, is losses from the stock going down, which means this is bullish. You can tell by looking at this profit and loss diagram, this is a bullish strategy because as the stock moves up or the underlying moves up, this has gain potential and loss potential when the stock moves down. So oftentimes there is a question saying, how do I when is a good time to write a covered call or sell a covered call? That's a synonymous term. It's when you're bullish on something or you still want to hold the stock, but it is a bullish strategy. So therefore, if you feel like the stock is going to go up and then you have a predefined target price, then that meets the criteria for this strategy. A cash covered put is also a bullish strategy. So this is on the other side. So remember, a long put is contains the right to sell something at a predefined price within a predefined time frame. The cash covered put is the sell side of what that right contains. So if the long put contains the right to sell, then the short put contains the obligation to buy at that price. And remember, on the short side, and I use this analogy, I feel all too often and way too much, but it really certainly helps understand the concept. If you're long an option, you're the driver in the car. You can go left, you can go right. It's ultimately your decision, which means you are the one who has the right to exercise that contract, and you will do that when it makes sense. If you are the short option writer, you're the passenger, and you don't know what the driver is going to do, but you do know if a red light is coming. You do know if there is a stop sign or if they're put their blinker on to go right or left. So you have to pay attention to your surroundings if you want to know what the driver is actually going to do. So if you are the seller, which is what we're talking about in the seeking income side, you are the passenger. So that's important to know. But what you're doing is you're utilizing the obligations that are inherent of options in both of these strategies. So let's add some clarity to that. For a cash covered put, this is where I want you to think about that mirroring that we were talking about earlier. This is the obligation to buy. So you have to have cash readily available to buy that security. So if you have the right to buy the obligation to buy at 50 per share, that you need to have enough cash to buy 100 shares at $50 per share. Now, if you have that cash available and you say, okay, I'm going to sell a put utilizing that cash as collateral, and maybe your intent is to utilize that obligation to buy the stock. That is very, very common with cash covered puts. You'll sell a put option utilizing that cash, and then that creates an obligation for you to buy that stock at the driver's discretion or the long option holder's discretion. The same profit and loss is true here. Your max gain is at the strike price. It's bullish. You don't want that obligation to kick in. Or maybe you do, and that's why we'll talk about best practices and how you can actually apply this. But your max gain is achieved if the stock is above your strike price, because that means the driver isn't going to execute upon the terms that the contract contains. And you still have substantial loss potential. It's the same equivalent to buying the stock, because your obligation is going to kick in if the stock goes down. And so you're going to buy, we sometimes like to explain this having a limit order even put next to each other, where if you have a limit order and you say, I'm going to buy 100 shares at $50 per share, you'll go ahead and buy that when the market hits your ask. So you're going to buy at 50. But then if you sell a put that says you're obligated to buy at 50, well, if the stock goes down to 40, your obligation is probably going to kick in, because you're going to be around here depending on prices. Your loss potential is actually less with the cash covered put, because you received premium, reducing your max exposure, if that makes sense. But we'll go over how it's actually applied. But as far as what a cash covered put is, it is a bullish strategy. You want the stock to go up because that's where you achieve maximum profit. And it's sometimes utilized to buy stocks. It's utilizing the obligation inherent with options to buy stocks. And then inversely, there's something called the wheel strategy, where you would sell a covered call to even specify your sell price once you buy that stock. So that's a really interesting way from an income perspective, how options traders will utilize options to define entry and exit points, even for buying ETFs or stocks.
Yeah, and I think the best way to really dive into this is go through a real example. So let's do exactly that. So the next thing I want to pull up here is a real example of a cover call. And this is a bit of a thought experiment to kind of get everyone thinking through the process of applying what you just learned. So I have a chart here on the left-hand side of Suncor Energy. At the time that we took the snapshot, it was trading around 52.13. Let's say you own this particular stock. You think it can continue to move higher because you like energy. You think the current global economic or global geopolitical environment that we're currently is conducive to further gains in oil prices and commodity prices. So you think that this stock can continue to move higher, and you want to be able to profit from that. But you also want to generate some income in the short run as you hold on to this asset. And that's predominantly what a cover call allows you to do. But the question is, when you pull up an options chain, you own this particular stock, where do you want to sell that cover call? You have hundreds, sometimes thousands of expirations and strike prices to choose from. So this is a thought experiment to help you better understand where you want to start. So I'll first do the first piece for you. I'm selecting an expiration date. I'm going to select 45 days out. And this is based on our research that we've done on backtesting this type of strategy. Depending on how far out you typically want to go with expiration dates on a short option, we tend to find that 30 to 45 days is generally your sweet spot. And with cover calls, we tend to go towards about 45 days to try to get a fair amount of income for the obligations that you're taking on. So the thought experiment here is, this is a $52 stock. Now, going out 45 days, where would you pick the strike price? Meaning, where would you feel comfortable having the obligation to sell the stock? So for example, I have three choices. I have the 58 strike, which is roughly $6 out of the money. That will collect $1.62. That's about 3% of the stock's value that you're going to collect in 45 days. I also have the 62 strike, which is almost $10 out of the money. That will collect 86 cents in premium, or 86 cents in per share. That's about 1.6% of the stock's value. And lastly, I have the 64. This is $12 out of the money, and then only collects 62 cents in income. That's just a little bit over 1% of the stock's value. And I want everyone here to bring up your chat window and type which strike price would you choose on selling cover calls on Suncor Energy. If you own the stock, and many of you may own this stock in your portfolio or similar stocks in your portfolio. I know a lot of you have energy shares in your portfolio. Which strike price would you choose? Select either 58, 62, or 64. Type your answers into the Q&A, or the chat window rather. Okay, we tend to see that the answers tend to skew towards 58 for the most part. We also typically see a lot of 62s. One, I think it's very obvious why a lot of people choose the 58s, simply because the annualized and the raw returns, or the static returns that you're collecting, is significant and the higher one of the three choices. And I think a lot of people also choose the 62s because they feel the middle one is always the right answer. But this is really where we've backtested this strategy across all potential stocks, across different strike prices, different expirations, to try to see where do you get the best outcome in the long run. And when you think about best outcome, you can't just think about the cover call itself. You also have to think about the underlying stock that you own, because if you own 100 shares of this, that's $5,200 that you're risking to own 100 shares of the stock. You have to factor that into your decision-making process when you choose your strike prices on a cover call. So I will outright tell you the right answer, and it's the answer that most of you did not choose, and it's the $64 strike. The furthest strike out of the money, the one that actually collects the least amount of income, is the strategy that's going to give you the best outcome in the long run if you do cover calls all the time on the stocks that you own in your portfolio. And a lot of people will ask, how is it possible that the strategy that gives you the lowest amount of income gives you the best outcome? Notice how the difference between the $64 strike and the $58 strike is only a dollar less in income. One, you're going to collect $1.62 for the $58 strike price. For the 64, you collect 62 cents. So you lose $1 on income. But what you gain is $6 in upside potential. So we all know stocks can rally, and we've seen some spectacular rallies. I think a lot of people owning energy shares this year did not expect energy to perform as well as it did. And guess what? If you sold cover calls that were too close to the current price because you were trying to collect an extra dollar in premium, chances are you would have given up $3, $5, $6, $7 in upside in exchange for one extra dollar in income. And because that one extra dollar is never worth the $6 in upside that you're giving up, that's why in the long run, when you choose strike prices further away from the stock price, when you're selling cover calls, that's actually the one that's going to generate the best outcome for you in the long run. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. So the next time you pull up an options chain, you're thinking to yourself, I want to sell cover calls, and you gravitate towards that strike price that has a nice, rich, juicy premium, think twice about that, because that juicy income might collect you an extra dollar in the short run, but what you're doing is you're giving away $6 in upside in exchange for a single dollar upfront today. And that equation over the long run, as you sell many cover calls throughout your hopefully long trading career, that's an equation that's going to give you a worse outcome in the long run than what you gain in the short run. Okay, so I'm glad everyone understands that. Let's move on to the short put side. I'm going to use a different stock, Canadian National Resources, trading at around $81. This is a stock that largely for the last few months have been range bound. Maybe this is a stock, but it is it's a strong performing stock. And actually, I apologize, Jessica, let's go back to one slide, because there's one thing I forgot to explain. Because despite the fact that we're collecting only 62 cents on income for the $64 strike, we're collecting 1.19% in 45 days. And I just want to put that into context, because when you own Suncor Energy, you can see the dividend yield on that screen. It says 2.98%. So you're gaining 3% a year holding onto Suncor Energy, which is, on the, I would say, average with respect to energy stocks, earning 3% dividend yield. Here, despite that you're only collecting 62 cents, you're still collecting 1.19%. So a little bit more than a third of the full year dividend yield, you're earning that in just 45 days. So if you continuously sell cover calls throughout the year, you're generating an annualized yield of 6.5%. That's double the dividend yield that you earn on Suncor Energy. And this requires the stock to rally 14% in a month and a half before you give away any upside. And a lot of traders hesitant on giving away upside, but really the stock has to make, in this particular case, a fairly astronomical move in order for you to give up any upside. And when it doesn't, you're going to collect roughly double the dividend yield for the week, for the month, if you will, that call doesn't get assigned. So that's just something I want to just show you in terms of how much yield you're actually collecting from that cover call. So let's go back to that short put on Canadian National. And this is a stock at the time trading around $81. And I want to do the same thought experiment. And I'm going to also pick the expiration date for you. And I'm going to automatically pick the 30 days. And there's a reason as to why typically for short puts, we use a shorter dated expiration. Usually 21 to 30 days is kind of the sweet spot for selling short puts or cash secured puts. And when the stock's trading at $81, I have three different strike prices. The 87 strike price, which collects $2.46. I have the $76 strike price that collects $1.76, and I have the 74 strike that collects $1.32. So same thought experiment. Which strike price would you choose if you were trying to sell a cash secured put to potentially acquire this stock? As we learned that you can sell cash secured puts to have the obligation of owning the stock, but having the income that you collect pay for part of the stock purchase, effectively giving you a discount. Which strike price would you choose? And I see a lot of 74s. And I'm guessing this is because of what you learned on the previous slide, that, you know, selling cover calls, you want to sell strike prices that are very far away from the current price. Well, when you're selling cash secured puts, the answer is the exact opposite. You generally want to select strike prices closer to the current price. So based on our back testing, the $78 strike, the strike that's closest to the current price, is actually going to be the one that gives you the best outcome in the long run. That $2.46, that gives you a 3% discount on the stock purchase if this 78 strike price gets put to you. Think about when you place a limit order, you know, on an $81 stock. Do you typically place limit orders at 74 or 72? Chances are you don't, because the chances of those limit orders getting filled at all are pretty small. And you generally don't want to have limit orders that have a low probability of being assigned or filled, because you want to own the stock. That's why when you're selling a cash secured put, you choose strike prices close to the current price. It increases your probability of owning the stock that you want to purchase, and you get the additional benefit of getting the biggest discount possible on your stock purchase. In this particular case, you get a 3% discount in 30 days if this put gets put to you. And if it doesn't get put to you, the cash that you're putting aside to potentially own these shares, you're earning 3% yield on that cash in 30 days. Annualize that out, that's 35% yield on your cash. So that's really why cash secured puts, you want to choose strike price close to the current price. Cover calls further away, cash secured puts close to the current price. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. I see a lot of 2s, and I know I've taken up a lot of time, so I'm going to pass this back to Jess, and we're going to talk about using options to gain from a directional move. So far, we've talked about income. Now let's talk about how do you potentially profit from a stock or ETF that you think is going to make a big move either higher or lower.
Yep. So we're going to the other end of that. And really there is a phenomena that happens when you first start trading options, is you end up with gaining directionally, and you'll buy a call, and then you'll buy puts, and then you shift over to the income side. So we really wanted to show you that first, and learn from others' mistakes, if you will. But let's go through the gaining directionally, because it's definitely important to know, and you can be successful if you know the components around it. And that's what we want to cover with you today. So I'm going to start with a long equity call, and this time I'm showing it to you a little bit differently with an example. So in this example, I've got, and I apologize, I'm screen over just a little bit. A buy to open 1 ABC call expiring July 22nd. So let's assume that's 30 days from now. At a strike price of $150 for $7. What this means is you have the right to buy 100 shares of ABC for $150 per share at any time up until July 22nd. And in exchange for that, you paid $7, which equals 700 total, because you bought one contract, multiply that times 100 shares, 700 total. Now, this profit and loss chart is showing the directional view that this is bullish, because we've got gains here on the right-hand side. But what you'll notice is you have to have the underlying move more than the premium that you paid, at least at expiration. And that's what this is reflective of, is at expiration. And that you need ABC to move more than the extrinsic value that you purchased for the security. And that's a very important component for long options that you definitely need to take into account. And that's why you go back to that previous screen where we said sharp upwards movement or sharp downward movements. And that indicates that you have a price target in mind that is more than that extrinsic value that you purchased, and preferably within a time frame, because that time is going to decay and it's possible to capture time profit back if you don't hold the option until expiration. But at expiration, if you hold that option that long, you need the stock, the underlying, to move at least more than what you paid for the long option. And that's true for long calls and long puts. So the max risk with these is just simply what you spent, because you own the right to buy. Therefore, it's up to you if you're the driver. So you can decide to execute upon those terms or not, completely your decision. And then you break even at expiration, at least when the underlying moves the amount that you purchased the option for, and then you start gaining if it's above that. So what's important to see from this is you still retain unlimited gain potential, but you have an option, which means you have an expiration date, which means you have a decaying asset, and that's something that you have to take into account. Long equity puts are just the opposite. It contains the right to sell, so it has substantial gain potential because the stock can only go to zero. So you profit as the stock goes down, you profit because you have the right to sell at a specified price. And this is individually. I saw a couple questions going in about long equity puts being attached to stock and things of that nature. That's a completely different strategy. So remember, if you have a driver of a strategy, and we're looking at this one individually. So just the long equity put, you gain directionally from strong downwards movement. And just like the long equity call, you need the underlying to move more than what you paid for the option in order to be profitable. And that is at expiration. There's time and other things that are true, and we'll talk about that in a brief moment. But the key takeaway with directional movements, which is buying calls and puts, is there is more to the option than just the movement of the underlying security. There is time that's involved, and it is a sharp directional move because you need the underlying to move more than what you paid for the option. And I know I say that usually about 10 times when I say that slide, but that's because it's really, really important and a lesson that a lot of people learn the hard way. And before I go on to the next slide, we really like to throw out a question here. When we talk about best practices now with directional trades is understanding how often options are actually exercised. So if you want, in the chat window, how many, and percentage wise, how many options do you think are actually executed upon? So and you can throw in any number there. Do you think 100% of options are exercised, or what's your percentage that you think people actually say, I'm going to execute upon the terms of this contract? And I see a lot of 10s, 5s, 1s, 80s. So it's everywhere. Yeah. But it's a variety. That's what's very interesting. 50. I like the odds of that.
The bulk of you are in the right ballpark.
So let's reveal what that is. So here's some key statistics, and these were pulled from the OIC website, which then linked to the OCC website subsidiary. So these are real statistics that show exactly how much are exercised, expire worthless, and are traded on the market. And let's explain that for a little bit. But 7% of options are actually exercised. So a lot of you, I think I saw 5, 10, 15, 20 a lot. That's, like Tony said, right in the right place. And that's important to know, because if you hold an option until expiration, that's not something that a lot of people do. A lot of them are actually traded out of the market. And you'll notice that's the vast majority. 70% of options are traded out of the market. What does that mean? That means that you bought to close, or you created a closing transaction of some sort for your option strategy, and you didn't have that option on the day of expiration, because that equals risk. And we'll talk about that in a brief moment. 23% of options expire worthless. And remember, that might be your goal. if you are a short option holder, as options get very, very far out of the money, which is beneficial for you if you're the one selling the option, they become illiquid and difficult to close, which means you may have to allow it to expire worthless. But that may be what your intent was. You may have absolutely wanted that. And only 7% are exercised, which tells us that it's very important to close out your options. And that's something the vast majority of traders do. Anything you want to add to that, Tony?
Nope, I think that covers just some of the stats that I think a lot of, there are quite a different views on kind of what people believe are, whether options expire or worthless, and a lot of, misconceptions about the fact that, if I lose money, does someone else make that money? And hopefully this kind of helps you understand that most option contracts are simply closed before expiration.
So let's talk about some risks that are important enough, and know that we're going to talk about assignment risks. So this is only applicable to short options. You don't have assignment risk when you have a long option. You have exercise rights. And so when you execute upon the terms of the contract and you initiate and exercise those contracts, someone else is being assigned, and that's a short option holder. And there's a long process that's involved with that. But if you are intending on writing covered calls or selling cash covered puts or holding a short option at all, it's really important to know the early assignment risks. The first one and the most common is early assignment due to an ex-dividend. So this is applicable only for short calls. Calls contain the right to buy something at a specified price within a specified time frame. Well, as an option holder, even if you have the right to buy, doesn't mean you're entitled to the dividend. Only long stock holders are entitled to the dividend. They have to own the stock the day before the X date in order to qualify for that dividend. So this is something where a lot of people get assigned early and they don't understand why. And let me just show you a really easy way to look at it. So we've got a security here in our example. It's trading at $88.09. This screenshot was taken yesterday, and they have an ex-dividend date on the 24th. So we are before the ex-dividend date. They're paying 92 cents a share. So keep that in mind. I have the intrinsic value on the screen, and intrinsic value is just the actual value of the contract. So this is the strike price 84. If I have the right to buy at 84 and the stock is trading at 88.09, that means this option contract should be worth at least $4.09, which it's got a really close expiration date. It's this Friday, so there shouldn't be anything more in excess of that. However, if I want to know if I'm going to be assigned early, or as the long option holder, say, I really want to get that dividend, I can get 92 cents a share. Well, if I were to sell to close this contract, me being the long option holder, I probably could get $4.20, somewhere in between this bid and ask. This is a very illiquid, but real example. And this is true with anything with an ex-dividend. That is not as much as exercising their option. So they will most likely exercise their option. Your probability of early assignment is extremely high in this scenario because they could exercise their option, buy at 84. They still are going to retain that capital appreciation of $4.09, and they're going to receive their dividend of 92 cents. So the math that you do there is you take the intrinsic value plus the dividend amount. If closing your option equals less than that, you are very likely to be assigned. And that's something to be aware of if you're writing covered calls, especially because that's a seeking income strategy, and you want to ensure that you keep that dividend. So that's an assignment risk that happens all too often. And that's also another reason why holding till expiration sometimes isn't a good idea. And the only way to really reduce assignment risk is by closing out the option. And we get that question quite a bit. And then the last risk that I want to make you aware of is we call it surprise assignment. Now, this is true if you hold any short options. So it could be a short put or a short call. But essentially the way options work, you can submit exercise instructions to the Options Clearing Corp, or OCC, up until 5:30 p.m. Eastern Time. But the option ceases trading at 4 p.m. Eastern Time. That means there's an hour and a half that someone could execute upon the terms of that contract, and you as the short option holder can't do anything about it. If there is large upwards movement or downwards movement in the post-market session between that 4 p.m. stop and 5:30 Eastern time, the only way the long option holder is going to capitalize on that movement is by submitting exercise instructions. Therefore, they're very likely to do that, in which case, in this example, you may have a short Tesla call at 1060. And I tried to pull a real example here with a chart that explains how this actually happened, because normally it's high beta stocks or stocks that move quite a bit where this is applicable. Tesla closed at 1056. So at the last trading day of the year, you would have thought, okay, my option isn't going to be assigned because the right to buy at 160 versus the market price of 1056, the market's more favorable, I shouldn't be assigned. But post-market, Tesla went to $1,100. Well, this person could make $40 per share by exercising, and that's quite a bit. Therefore, they would have done that and you wouldn't know until the following business day. And that's because the exercise process and the assignment process is across brokerage firms, and it takes an overnight process. So the only way for the long option holder to capitalize on that movement is purely by submitting exercise instructions. What does that tell us, though, when we're trading options? Is it's just super important to close out your risk and just be aware of the underlying security and its movements and what it's intended to do, especially with volatile environments.
Yeah, and some of these risks may seem scary, and you might think to yourself, how am I ever going to think through all of these risks? Well, one of the great ways to mitigate these risks is to simply close out your trades before expiration. If you close out your trades before expiration, whether you're long or short, you will not have most of these risks. So those are some of the easy ways, if you will, to mitigate some of these risks. We're just saying these things to help you understand what risks there are if you do hold these trades to expiration. So let's talk a little bit about some of the best practices around options trading and show you some of the reports that OptionsPlay publishes to help you implement some of the strategies that you've learned here today. But I always encourage, start with education, especially if you're brand new to options trading. It is enticing to jump right in and learn. And for those of you that have tried to jump right in, I'm sure many of you have seen opportunities where you think that you're going to make money, but you actually lost money and didn't really understand why. And that's probably the most common thing I hear from options traders who jump in without really going through all of the education. What you have here at Questrade is a fantastic group that teaches you how to trade options. So take advantage of that at Questrade. And the best advice that I have for you is always have a sentiment established in the underlying stock before you look at any option strategies. I tend to find a lot of traders, you tend to gravitate towards one strategy or another, and you don't really consider kind of what is the best environment for that specific strategy. It's important to understand what environments are beneficial for a specific strategy and only deploy in those specific environments. And generally speaking, those environments are either bullish, bearish, or neutral. So you have to first establish your directional view. If you don't have the correct directional view, chances are you're going to lose money on that particular trade. It's important to understand why you lost money on that trade. The second thing I encourage you to do, which is have an exit plan. Before you get into every single trade, whether it's an options trade or an equity trade, have an idea as to when you're going to get out. That's going to help you prevent huge losses. I've seen as a market strategist over the past 16 years, some pretty spectacular account blowups. And these typically all occur because the trader didn't have a plan as to when they were going to cut their losses and get out of the trade. They just kept letting losses compound, potentially even taking on more risk, trying to get back to break even. And this all happens because there wasn't a plan to get out of the trade, either at a profit or a loss, and you kind of just wing it as you go along. And that's the worst thing that you can do, especially when you're facing a loss in your portfolio. And many times we as traders and as human beings don't want to take a loss. We do things to try to mitigate that. And sometimes the things what we do to mitigate loss actually cause us to lose substantially more capital than we originally intended to with that first trade. And if any of you can relate to that, type 3 into the chat window. And lastly, use the tools and resources that are available to you. Questrade is one of the few Canadian brokers that offer multi-leg execution. And while today we didn't talk about any of those multi-leg trades, what we did talk about is really some of the foundations that you need to learn to start utilizing those multi-leg option strategies. And those option strategies will be able to help you mitigate some of the risks that we've discussed here today, and really kind of get the best of both worlds of buying and selling options, because both of them have trade-offs, and when you combine them, you can really get the best of both worlds. And being able to execute those electronically at a low cost at Questrade is something that you don't see at other Canadian brokers. So I hope that you guys take advantage of those resources. So with that, what I want to just wrap this up with are 2 resources that you have access to free of charge, courtesy of the Montreal Exchange and OptionsPlay, the partnership that we have that helps you implement 2 of the strategies that we discuss here today, which is cover calls and cash secured puts. Now, I went through the thought exercise with you for selecting expiration date and strike prices on stocks that you own for Suncor Energy for cover calls and Canadian National Resources for short puts. But obviously, you have other stocks in your portfolio. And to help you do the work of picking expiration dates and strike prices, we have generated this cover call and short put report every single day so that you know exactly which expiration date and strike price would align with what I taught you here today. So if you're looking at, let's say weed, a $4.25 stock, if you sell the July $5.50 strike price on weed, you're going to collect, in this particular case, about 5% of the stock's value in income. And so this selects the expiration date, which in this particular case is July 15th, and also selects the strike price for you, which is $5.50. So it does the work for you in terms of selecting expiration dates and strike prices, and then gives you the yield analysis. And you can click on the link here on the right-hand side to actually see that trade in OptionsPlay so that you can analyze it further before you execute it. You can either access it through the link on your screen, or you can point your phone onto that QR code here on your screen, and that will take you to this cover call opportunity report. And we do the same thing for the short put. We basically give you the exact expiration date and strike price that you would choose if you're selling a short put. And you can access both at the same QR code. It's just 2 different tabs at the bottom of the sheet. It is a Google sheet that you can download if you want to download them and sort and filter through it, or you can just access it. And this is updated every single day, and we sort the opportunities from the highest yield to the lowest yielding opportunities. So if you're thinking about selling cover calls in a portfolio of stocks, you can simply go down the list, find the stocks that you own that has the highest yield, and start there and work your way down the list. If you have limited amounts of time, you'll know where you're going to generate the most yield and where you want perhaps to spend some time using these 2 reports. And with that, what I'll do is I'll wrap this up with just showing you how to access all of the tools that we have built here at OptionsPlay in the partnership that we have with the Montreal Exchange, completely free of charge at tmx.optionsplay.com. You'll get access to our daily income opportunity reports. You'll get access to our monthly education sessions like the one we're hosting here today with Questrade, and you'll also get access to the full OptionsPlay platform for Canadian securities, along with the cover call and short put report that I just showed you here today. So with that, thank you, Jessica, and thank you, Questrade, for hosting this fantastic event and allowing us to come here and talk to you guys about these option strategies and really do a deep dive into some of these strategies. And at this point, what I'll do is I'll pass this back to Jonathan, and we'll do a live Q&A session with you guys.
Thank you very much, Tony and Jessica. We greatly appreciate the presentation today. I know I learned quite a bit about options and even increased my knowledge, so I hope our customers had some great takeaways as well. We had a lot of questions roll in, and just because we are at time, I'm going to limit how many questions we get through just to respect everybody's time a little bit. But I did still want to get through a few questions that did come up repeatedly. I guess for either of you, do we have a simple way, maybe in a 1 or 2 sentence kind of answer of explaining how to roll over an option? So let's say somebody's stuck with an option contract that's approaching expiry and they want to roll it over. What do we mean by rolling over? How can we kind of boil that down and really simplify it for someone who's maybe never done that before?
Yeah, I get this question a lot, and rolls sound complicated, but it's actually really simple. What you're doing is in a single order, you're putting in order to close your existing position and open a brand new position. So don't think of it as 2 trades. Think of it as really just opening a new trade. but what you're doing is you're closing your existing trade at the same time in a single order. So if you're selling, let's say in a July 130 cover call, and now that you're approaching that July expiration, now you want to sell an August cover call, a roll is simply just closing your July trade and establishing a new August expiration. Hopefully that helps answer the question.
That definitely does. And we'll have some more resources as well that I'll get my colleagues to post in the chat, but that definitely helps explain rolling over. I had another question that was more related to OptionsPlay platform and maybe some of the future improvements that you guys are working on. We had some great comments from our customer Bob here. Will the TMX version of OptionsPlay be moving to the new version used by OptionsPlay with US stocks? So I know there's slightly different versions between US equities and Canadian equities. Any improvements maybe coming to the Canadian side?
We are actively in the process of upgrading the Canadian side to that new platform. So that is actually coming in the next month or so.
Oh, wow. That's great news. So maybe just keep an eye out for that updated functionality. Awesome. And then we'll finish off with one last question here. I do notice a couple of very long questions, and I apologize that we can't get through all of them. We will follow up individually where we can if there's anything important that has come up. But let's finish off on this one here. Is there a delta value specifically, and delta is referring to one of the Greeks used for trading options for anyone who's not familiar with them? Is there a delta value that historically works better when you're, let's say, selling a covered call or maybe a long put or something like that? Is there like a historic delta value that we should watch for, or maybe a range?
Absolutely. And I'll let Jess weigh in after I speak here. But generally speaking, when you're selling cover calls, we tend to target around the 15 delta strike price. So a strike price that actually has a pretty low probability of the stock reaching that price. So 15 delta refers to a 15% chance the stock will reach that price or higher by expiration. And this is done by design so that 85% of the time you're going to collect the income, and that 15% of the time when the stock really rallies, you're going to potentially profit from that big move in the underlying stock. And I think you asked the secondary part of, if you're buying options, what type of delta do you choose? I tend to gravitate towards a delta that's very close to at the money, slightly in the money, preferably about 50 to 60 delta. I like to have a little bit of intrinsic value, as Jess taught you about intrinsic value. I like to have some intrinsic value, so I'm not just paying purely for time value, so that even if the stock doesn't move in the short run, I'm not seeing the value of my option evaporate very quickly.
I should probably take a couple lessons from you, Tony, since I have a tendency to buy very out of the money options myself. So I'll maybe learn something there.
There's nothing wrong with that.
Yeah.
There's absolutely nothing wrong with that. It's just a matter of understanding what your risks and rewards are with the different options. And Jess, I didn't mean to cut you off.
Oh, that's okay. And the only thing I would add to that is looking at gamma. I think that's really important when you're have long options. So looking for something that is relatively close to the money, but also has a higher gamma, and higher gamma means higher movement of delta, which is what you want for the option to be profitable if you're long options. If you are short options, high gamma equals risk.
It's a really great summary. So if you're short, you want lower. If you're long, you want higher.
Yeah.
Awesome. Well, thank you again, guys. We really, really appreciate your time today. And we're hoping to maybe do some more of these in the future. Thank you again to everybody in the audience who did set aside an hour from their afternoon. And please watch out for the post-webinar survey as well, which will automatically appear in your browser, and the recorded copy of the webinar, which should be sent via email early next week.
Thank you so much, everyone.
Thank you so much for having us.
Thanks, and have a great afternoon, everyone. Bye-bye.